giant even if you're really, really small. It's about picking the leaders of tomorrow,
Growth in the Indian economy moderated in the second quarter of the current financial year. Q2 GDP has come in at 7.1% as compared to 8.2% in the first quarter. Some amount of slowdown in growth was anticipated, but this is a touch more than what had been predicted by a poll of economists who were expecting 7.5% GDP growth. Joining us to discuss some of the insights that come through from this data, Dr. Pronab Sen, former Chief Statistician, Soumya Ghosh, Chief Economist at State Bank of India, and Joshi, Chief Economist at CRISIL. Thank you all so much for taking the time to speak to us. Mr. Joshi, let me start with you. Interesting set of numbers. I think if you look at the sectoral breakup, pretty much every sector has seen some slowdown. But if you actually look at the expenditure side, there are some positives. For instance, the fact that investment has continued to remain strong.
True. I think from the expenditure side, it is only private consumption slowdown, which is the bulk of GDP, that's responsible for the slowdown in the growth to 7.1%. The private, the government consumption expenditure, private overall investments and exports, I think they've all accelerated. The growth rates are higher than they were in the first quarter. So that's the expenditure side of the story. I think from the supply side, if we see, the drag is coming from services. I think the non-service part of the economy is doing reasonably well. The services which used to be the driver, they have slowed down, and I think this slowdown has been, this is the third quarter they're showing below trend and very weak growth rate. The finance, real estate, trade, I think these segments are not growing above, perceptibly above 6.5%. So they're all below 6.5%. I think this is what used to fire growth earlier. And some of the reasons are explainable. I think the financial sector, the slowdown, particularly the banking sector, is also getting reflected in GDP. Telecom sector gets into the other part, the communication part. So I think unless these start reviving, the decisive upward trend in GDP is some time away.
Mr. Ghosh, is that your broad analysis as well? And then I'll get into specifics.
See, I have broadly 3 points to make. The first is that the private final consumption expenditure had indeed slowed down significantly in second quarter. The constant prices, the year-on-year growth rate is around 7%, which is down from 8.6% in the last quarter. So that's point number one. The point number two is that if you actually look into core GVA, basically which excludes the agricultural sector and the public sector, the public administration, that has significantly slowed down to 6.6% from 8.6% last quarter. So that means there has been an overall demand slowdown. And the third thing is that the apparent distinction, the apparent contradictory growth rate of the agricultural sector and the non-agricultural sector now looks clearly visible. If I break down the GVA into non-agri GVA and agri GVA, the non-agri GVA has expanded at 13.4%, nominal non-agri GVA, and the agri GVA has actually now collapsed to 2.8%. And in fact, the agricultural GDP deflator, if I calculate it, that is now at negative. September is actually at -1%, which is for the first time till June 2017, the agricultural sector, the price deflator has turned negative. So this indicates that there is a significant element of rural distress which is happening, which is perhaps adding on to the overall sentiments. And apart from the factors which Joshi mentioned in terms of the service sector, I say this is also one of the factors which is dragging down the overall growth rate.
All right, those are great insights, Mr. Ghosh. Dr. Sen, I'm coming to you last so that we can get a slightly broader picture from you as always. What are you seeing in the growth rates that you've seen in the past few quarters and in this quarter? 8.2, while not an outlier, but clearly seemed like it was boosted at least by, a base, etc. Wasn't reflective of any dramatic strength in the economy which was lasting.
Well, there are a couple of things. The first is the base effect, of course, does certainly play a role. The base effect in the first quarter was strong and it's starting to wane, and it will continue to wane as we go forward. But that apart, I think there's a more fundamental economic story that needs to be told, which is that, you know, consumption behavior is usually fairly predictable, in the sense that even if there is a downward pressure on the growth in incomes of people, they do try and maintain the consumption behavior over time. But after a while, the pressure becomes too much and consumption tends to go down. If we are seeing the beginning of this downturn, then it can in fact be persistent. So that's something we're going to have to watch out. At the moment, it's only 1 quarter of data, but that's a very real danger.
Okay, let me just talk about that consumption story, Mr. Joshi. So it slowed down compared to last quarter, yes, compared to the growth rates of last quarter. But at 7% growth, would it not be more or less in line with long-term averages that we've been seeing on personal consumption expenditure growth?
Yeah, I think that is true. So it's basically kept. It's growing at the same rate as the overall GDP. So its share in GDP would not change. I mean, at this rate. But I think what we are trying to explain here is why did the growth slow down? And I think perceptibly, I think the first quarter personal consumption expenditure was very high. The rate of growth was 8.6%, much higher than the trend, and that kept the growth going. Now that has slowed down, so incrementally, I think that's contributing to slower growth. I think that's the point. And the private consumption slowdown, one is of course waning of base effect, but otherwise, I think we saw the oil prices high, so that they also steal somewhat from the private consumption. And on top of that, the interest rates were also rising in the system at that point. I think all these are negatives for private consumption.
Just to sort of take that conversation forward, so there'll be two contrasting factors which will play out in Q3 and Q4. Mr. Ghosh, let me come to you on that. On the one hand, you will see relief on oil prices, so any sort of demand impact of oil prices will perhaps ease given the way oil has moved. On the other hand, you will see the NBFC story, or the shortage of credit start to play into the growth numbers. Everyone expected that the second half will be slow. With a 7 point, with a number this low for the current quarter, what would you expect Q3 and Q4 to look like, Mr. Ghosh?
See, I think the first thing I want to mention about the base effect, I think the base effect impact this quarter we are estimated around 30 basis points. So from that point of view, I think on an excluding, if I strip out the base effect, the GDP growth rate for this quarter is already trending below 7%. The important thing is that you talked about the consumption expenditure. Yes, the consumption expenditure has slowed down, and if I actually make an time series analysis and look into the consumption expenditure, I can see that the first quarter of FY18, the consumption number was, and the second quarter was not significantly different from the 7% which we had this quarter. And the important thing is that consumption expenditure has significantly declined. It has significantly increased in the last quarter. So that means that there is an element of uncertainty in consumption expenditure, which is likely to play on the investment expenditure if it persists. So this exactly this uncertainty which you just talked about, this credit growth, this NBFC uncertainty. And I hope that this uncertainty doesn't last, because if this uncertainty lasts, then this could have an impact on the consumption expenditure, and that in turn could actually negate the investment revival which we are now witnessing to some extent. There is some amount of investment revival, but that could actually be impacted if this uncertainty continues for too long.
Dr. Sen, what's your thought on the investment side? I assume that gross fixed capital formation staying strong is still suggesting some amount of catch up with the consumption that has been happening so far, and capacities are now starting to get filled up. So perhaps that is still reflective, or is it more government driven?
No, I think there are a few dimensions we need to note. One is that the government continues to be an important player in the capital formation process, and that's a very good thing. On the other side, private capital formation, one has to be very careful in not reading too much into investment. Remember, investments can happen either to increase capacities, production capacities, or it can happen in improving technology, that is, improving productivity. Now, if it is the former, then yes, it's a good thing going forward. If it's the latter, that is, it's a lot of the investment is going into improving technology, it may actually continue to put downward pressure on employment, and that would then in turn affect consumption, which could negate the positive effect of the uptick in investments.
Okay. Mr. Joshi, if I can come to you on another aspect of the data, which is agriculture. I know the numbers tend to be fairly volatile, but what is your sense of whether this is on par with expectations, or is there something behind the numbers we should watch for?
Well, I think the real numbers are on par. I mean, the last, I think if this year's agriculture growth stays at around 3.5%, then the average for last 3 years would be around 4%, I think, which is much higher than the trend value. I think nobody has problem with agriculture production per se, but the issue is that the nominal agriculture GDP is not growing as fast as it used to grow. Though it's in a way good for urban consumers that the food prices are not rising too much, but I think for the farming community, I think it's a drag for them, and I think it, in a sense, displays that the farmer realizations have been going down, and that's getting reflected in lower nominal growth in agriculture GDP. I think that's somewhat of a worry, and government did try to correct that through MSP increases, etc. But so far, I think that doesn't seem to have had any effect on or maybe no perceptible effect on food prices or the realizations of the farmers.
Mr. Ghosh, if that rural, sort of demand story remains weak, as you pointed out, because of the nominal numbers there, and on top of that, you see some curtailment on, credit in the personal space, so personal credit, etc., slow down because of NBFCs, then you'll see perhaps both urban demand and rural demand slowing, maybe at least in the third and possibly in the fourth quarter?
Yes, I think the important thing about the agricultural is that the nominal agricultural GVA is actually lower than the real agricultural GVA, and that has again happened in the September quarter, and this was and last time it happened was in the June 2017. So we are actually back to square one. So there is a significant depression of the rural prices. And regarding your point on the demand compression, yes, rural demand has been declining. If you look into the rural-urban differentiation in terms of the prices in the rural and urban areas from the headline CPI numbers, you can see that the rural prices have been declining faster than the urban. But my sense is that the demand moderation could have continued a little bit into the third quarter. How much of the impact of the oil prices could impact on the urban demand is a matter of debate. But I think that third quarter may not be significantly different from the Q2 in terms of the numbers, overall numbers.
Dr. Sen, what's your perspective on this agriculture space? I know we've had a longer, deeper conversation, but as things stand, the data is not suggesting much improvement in the price scenario in the agricultural sector, which of course has its other consequences too.
That's correct. I mean, the weakness in agricultural prices is a serious issue. And I think, as Mr. Joshi pointed out, that the MSP increases do not seem to have had any perceptible effect on the agricultural prices. And, that is by and large expected, because as far as the MSP is concerned, for most agriculture, the MSPs are just indicative prices and have virtually no role to play in determining what the final bargain between the trader and the farmer is. Those go by the perceived ability to sell and at what price. And so the feeling that one gets is that nothing much seems to have changed. And I think Mr. Ghosh is right as well, that this is just going to persist for a while. Now, the weakness in farm prices also actually ties in with the demand story. Because remember, 70% of your population is in rural areas, and although only about a little over half of them have the bulk of their income from agriculture, nevertheless, agricultural prices do feed into the overall rural economy very substantially. And if rural economy is hurting, then demand is going to remain weak for a while.
Okay. Let me just ask you a question. Let me go to Mr. Joshi on this first. So the government side, the government expenditure has been pretty strong in this quarter, the year-on-year growth. We've just gotten data for the fiscal till October as well, and that's telling you that government has already outstripped its fiscal deficit target for the year. They're at above 100% already in the April to October period. How is this going to play out, Mr. Joshi, in the remaining months? Pressure on fiscal is now there in the numbers to see. Plus, the government continues to support growth as is visible from the GDP numbers.
Yeah, I think they might, if they want to maintain 3.3% fiscal deficit, then they will have to they'll have to slow down the expenditure side. But I think one should also remember that we are talking only of central government expenditure. I think the bulk of expenditure from the government comes from the states. So I think what they are doing, I think, will also have an impact on what happens to the overall government consumption. And we do not have much information on the state level as of now. I think we'll come to know only later. But I think the central government is not the key player in firing the government consumption expenditure.
But Mr. Ghosh, wasn't it expected that the states will in any case slow this year compared to at least last year?
It's difficult to say because a lot of states are going into the election year, and so there is already a promise of a lot of debt waiver is in the air. So I'm not sure whether the states are going to, I mean, all the states, the expenditure pruning on the part of the states, will that be fruitful? So my sense is that the fiscal deficit this year is going to be a challenge for the central government in terms of meeting the 3.3% target.
Okay. Dr. Sen, now that we have a series of data on the new series as well, a longer time series, and I'm not getting into the debate over that time series. My simple point was that if one gets growth between, say, 7.1 to 7.5, even at the lower end of that range, it would be actually pretty much in line with what the trends seem to suggest. I mean, we shouldn't scoff at 7% because that seems to be what we can do in a sustainable manner.
Well, it depends again upon what you mean by the trends. If you are talking about the new sort of backcast series that came out day before yesterday,
yes, sir.
Compared to that, yes, 7.1 seems to be pretty much on line. But you have to realize one thing. That backcast series reflects only the increase in volumes. Whereas the 7.1 we are looking at today contains both volume increases as well as productivity gains. So we are not comparing like to like.
Okay.
So one would have expected that if productivity improvements are happening, then it should be significantly higher than just the volume growth.
Okay, point noted. Mr. Ghosh, 7.1, 7.2 full year growth with inflation at 3.5%. I can't imagine how the MPC would justify anything more on the rate front. If anything, they'll be under pressure to explain why they changed their stance last time around.
No, definitely. I think the decision, I think the last time the decision not to rate hike was a very bold decision, but at the same time the decision to change the stance could have been done a little earlier. So this time I think they will be under pressure to change the stance, but I think they will maintain this stance, and possibly if the inflation rate continues to behave in the way it is doing, there could be some rethinking on the change in stance by the central bank at a later date. I mean, maybe in the February policy or in the April policy.
Mr. Joshi, then last question to you. Second half, what are the biggest uncertainties now? Not oil anymore. Is it the domestic credit issues, or is it more than that?
I think there are two issues. I think one is that the global economy is slowing down, and that will also filter towards us. And I think we are seeing a downward drift in emerging markets, particularly Asia. So that is one downside risk which is gradually playing out. On top of that, I think the credit issues, if they persist, I think they also finances, after all, the lifeblood of the economy. They will have an impact on gradual impact on growth as well. So I think these are the two risks to watch out for the second half of the year.
Would you expect to bring down your target, and what is your target, Mr. Joshi, for the current full year, the GDP growth?
We are working with 7.4% with downside risk.
Mr. Ghosh, what's your number for the full year?
Or downward bias, let me put it that way.
Okay. Mr. Ghosh, your expectation for the full year?
I think our expectations of GBA was 7.3 and GDP 7.4. For now, I think the number should be closer to 7% rather than 7.4.
All right. Thank you all so much for joining us here on Bloomberg Quint with that quick analysis of the GDP number. I think the few important points that was made is that services by far is one important reason for the slowdown. Of course, in comparison to last quarter's numbers, even most of the industrial segments have shown slower growth. On the expenditure side, there is a slowdown in personal consumption expenditure, but the investment numbers continue to remain strong, at least for now. Thanks for watching Bloomberg Quint. Do go to bloombergquint.com for more analysis of the GDP numbers.